You have data everywhere, but is it working together? Meet Curator, the automotive industry's first unified intelligence engine. Curator unifies data from all corners of your dealership to transform marketing, sales, and customer interactions. See it today at goobagoo.com.
Welcome to Daily Drive for Tuesday, November 12th, 2025. I'm Jake Neer in Detroit, in for Kellen Walker. Today on the show, Toyota announces another massive U.S. investment, Waymo hits the highways, pulling further ahead of Tesla in the robotaxi race, and GM reportedly wants parts makers to pull supply chains from China. Plus, KPMG's Lenny LaRocca joins the show to talk about ongoing turmoil in automotive supply chains and what's ahead for EV investments.
We really sort of view this year as a real year of uncertainty and compounding volatility.
Let's run through all the news you need to know to keep up in the auto industry. Toyota is making another big bet on American manufacturing. The automaker says it will invest $10 billion in what it calls future mobility efforts across the U.S. Toyota hasn't said exactly where all the money will go, but North America CEO Ted Ogawa says the move strengthens Toyota's commitment to U.S. workers, dealers, and communities.
This is tied to our build where we sell, buy where we build philosophy.
That announcement comes as Toyota launched production at its first U.S. battery plant in Liberty, North Carolina. The new facility will eventually include 14 production lines, supplying batteries for hybrids, plug-in hybrids, and a new 3-row electric vehicle that's still under wraps. Waymo is taking its robotaxis onto the highway. The Alphabet-owned company says fully driverless freeway rides are starting this week in San Francisco, Phoenix, and Los Angeles. Co-CEO Dmitry Dolgov says the move will make trips faster and marks a major milestone for autonomy. It also strengthens Waymo's lead over Tesla in the race for robotaxi dominance as Tesla continues testing its service with human safety drivers. With the move, Waymo's Bay Area coverage expands to San Jose, including new airport service. And General Motors is asking thousands of its suppliers to cut China out of their supply chains. That's according to a Reuters report citing people familiar with the matter. The automaker has told parts makers to start finding alternatives for Chinese-made parts and materials, with some facing a 2027 deadline. GM says the move is part of a broader push for supply chain resiliency. That's as U.S. automakers grow increasingly frustrated with trade volatility and political risk tied to China. A GM spokesperson declined to comment on the company's discussions with its supply base. CEO Mary Barra has said the company is trying to move more of GM's supply chain to the U.S. And those are today's headlines. You can find more details on all of those stories at autonews.com. Speaking of U.S. automakers rethinking their ties to China, there's another piece of this story that's just as critical: the minerals that make modern vehicles possible. Reporter Molly Boygan has been digging into America's deep dependence on China for rare earth elements and how that happened in the first place. She joins me now from her home office in New York City to explain why rebuilding the supply chain here at home could take decades and why the U.S. may never fully catch up. Molly, welcome back to Daily Drive.
Thanks for having me, Jake.
So you have a pretty comprehensive couple of stories here about the United States' dependence on China for rare earth minerals. You know, we've talked a lot on the show about that dependency, and we've actually seen some of the effects this year of that dependency. But what a lot of listeners might not know is that we actually had a supply chain of rare earths here in the United States in the past. What happened?
There were a few factors that really just coincided as the perfect storm to negatively impact the U.S.'s domestic supply chain for rare earths. So the U.S. had ample rare earths at a mine in Mountain Pass, California, which was discovered in the late 40s, and for decades had not only the material, but processing capacity and the ability to produce the products that rare earths go into. So, for example, General Motors and a Japanese company both actually by coincidence, independently, but at the same time, developed the first rare earth magnets that they both announced at a conference in 1983. So the US really was at the cutting edge, not only of the mining and processing, but of the production of rare earth magnets. Then in the 80s, the US basically changed the way that it classified a material called thorium, which occurs naturally in rare earths. It's kind of like a contaminant, and the government classified this as something that could go into fissile material, that could go into material that would be made to make a nuclear bomb. So that created all of these new requirements for waste handling and other requirements that made it really difficult to continue the manufacture of rare earths in this country. Around the same time, China developed its own rare earths capacity. And, this was around the time that the Chinese government was looking at the economy, looking at the country's lack of domestic fossil fuels and saying, okay, we better invest in heavy industry, we better invest in renewables, with just incredible foresight bordering on prophecy, I would say. And they then developed this supply chain over the course of decades, just as the US's was kind of declining. And, China also had a price edge, which was enabled by lower labor costs and less environmental regulation. And so US companies began processing their material in China and using Chinese companies. And little by little, just the domestic industry was just decimated.
Since it sounds like the US has the capability, at least based on what we've done in the past and some supply at the very least, how likely is it that the US could eventually catch up with China if it tried?
So you're right that the US does have rare earths geologically. The challenge is in processing. The Chinese government has just created a very well vertically integrated supply chain. So, for example, some rare earths are harvested from the process of producing iron ore. So it's almost like they already have the kind of feedstock to be able to produce rare earths and process them easily while producing iron at the same time. For something like that for the US, I asked analysts this question, and it's sort of hard to estimate because in addition to already having the vertical supply chain, China, because of its volume and because of the dominance it's built over the years, also has a cost edge. So, long story short, I think it would be really hard and would kind of take the government firing on all cylinders for decades, like the Chinese government did in the 80s, to begin to compete in any meaningful way with the Chinese government. The one caveat that I will say is it's possible that the US will develop a rare earth supply chain as kind of an insurance policy. So, in the event that something like rare earth export controls are implemented again, the US will not be completely without supply. But in terms of competing on the global stage, it's unlikely that the US will match China in the near future. And I would say even probably in the medium term future too.
It's a fascinating and really important topic for the automotive industry here in the U.S., and we'll hear more about this story tomorrow on Thursday's show. Molly, you spoke with Colin Hendricks of the Peterson Institute for International Economics, and again, that's coming up on Thursday's episode of Daily Drive, so make sure to tune in for that. Molly's story is titled China Dominates Rare Earths. The U.S. May Never Catch Up. You can check that out on autonews.com. Molly, thanks so much for joining us today.
Thanks, Jake.
Coming up, KPMG's Lenny LaRocca joins the show to talk about the state of automotive supply chains and EV investments as we near the end of 2025. That's next on Daily Drive.
Your dealership has no shortage of customer information. But when that data is conflicting, messy, and spread across a multitude of platforms, it's impossible to activate properly. As the automotive industry's first unified intelligence engine, Curator enriches and unifies your customer data across platforms, like your CRM, your DMS, your website, and even your marketing efforts. It then injects that information back into your most vital systems to provide a single view of each customer and equip your sales team with the information they need to close a deal. When one of the largest volume Subaru dealers in the country wanted to tap into its data goldmine, they turned to Curator. In just 4 months, Huberger Subaru experienced a 55% higher closing ratio and a return of 15 times their investment. Want to see it for yourself? Check out the case study at goobagoo.com/curator. That's GUBAGOO.com/curator.
Welcome back to Daily Drive. I'm Jake Neer. It's been a year defined by volatility for the global automotive industry, from shifting trade policies and tariff uncertainty to slower EV adoption and rising competition from China. To help make sense of it all and to look ahead to what 2026 might bring, our own John Irwin caught up with KPMG's U.S. automotive industry leader, Lenny LaRocca.
Lenny LaRocca, welcome back to Daily Drive.
Thanks, John. Happy to be here. Absolutely.
Yeah, there's no shortage of things that we can talk about right now, but it's hard to believe we're already toward the end of 2025. It's been a very eventful year for the auto industry, between ups and downs with changes in trade policy, electrification, changes to automakers, EV plans, etc. As we kind of look back at this year, I kind of was hoping maybe to take stock with you of kind of where we're at right now. What's your sense of how the market and the auto industry in general has been holding up, I guess, on a global scale, just considering all of the changes that we've been seeing this year?
Yeah, absolutely. Absolutely. I mean, I think you could really define this year as a year of uncertainty, lots of volatility. I mean, you had a lot of volatility around tariffs, depending on what day of the week it was, different tariffs coming through, the EV slowdown, right? EV volumes sort of really coming down this year compared to what people were expecting. And you had a significant impact of the Chinese OEMs on the global market. And so we really sort of view this year as a real year of uncertainty and compounding volatility. And so if you take a step back and we think about what's going to happen for next year, I really would like to just maybe kind of go around the world, right? And then land in the US. And so in China, I mean, China market's still very strong. The China market is growing. There's impacts under the hood, though, in China, right, that you don't necessarily see here from the U.S. So the China market is significant overcapacity. So they have capacity of about 50 million units and they produce around 30, right, just broadly speaking. Chinese OEMs don't really make any money in China. So they're, even despite all the subsidies that they get from local governments. So when you take a step back, China is growing, but they're not really generating cash flow, right? They're not generating return. And so we've anticipated that there needs to be more consolidation in China, right? There's 100 so brands, but consolidation by itself doesn't necessarily drive cost reductions, right? You would really need to sort of consolidate plants, get the capacity more in line with the utilization. And so there's still work to be done in China to really make the Chinese market profitable. Right now, there's significant price war in China. But that being said, Chinese OEMs are super innovative. They've got great product, very low cost product, and because they have to in their market and the hyper competition. So I think you're going to continue to see Chinese OEMs look to exports and look to go abroad. And so that kind of brings us to Europe, right? In Europe, the traditional OEMs sort of went all in on EVs, right? So it was like, we're going to go straight to EVs. They built plants specifically dedicated to EVs, and the EV volumes in Europe aren't where they thought they would be, right? It's moving much slower than anticipated. It's costing a lot more money. And so you're seeing the Chinese invest in Europe. The Chinese OEMs are investing in Europe. And so I think at this point, Europe's, I think, going to take a step back and look at hybrids as a more medium-term solution, right? Instead of going directly to EV, I would anticipate that a lot of the investment dollars that were going to go into EVs are now going to be diverted into hybrids, plug-in hybrids, and range extenders, right? So I think that market is going to continue to fluctuate. I mean, unlikely going to grow by much there, but if they can't right size the portfolio and pivot to hybrids, you're going to see much more restructuring in Europe, right? You've already seen some announced, some plants getting closed. And I would think that's going to be much more in the near term if they can't pivot. So maybe we should go to the U.S. What kind of questions do you have on the U.S. side?
Yeah, all sorts. But considering, this year in the U.S., obviously we're I've been covering for automotive news a lot of the trade policy changes that we've been seeing. And a lot of that, the idea behind it at least, is to bring in manufacturing to the U.S. But I've seen, automotive companies in the U.S. or in North America more broadly have, viewed the market as, North America. It's not necessarily just U.S. They viewed like the supply chain as like a North American supply chain. Given trade policies and everything else, is that changing to any meaningful degree, or how might that change moving forward? As we look ahead to, the new year and beyond, is that changing to any meaningful degree, and how might that look if so?
Well, you're starting to see. I think you're starting to see the OEMs and suppliers really move past. So when the tariffs came out, it was sort of like, what's my immediate now term strategy, right? Like, I've got to come up with ways of mitigating the cost. Maybe easy moves you could make to mitigate the tariff impact, right? So if you had excess capacity in a facility, you could maybe move some production there, or maybe move some suppliers to the US that might help you save money. So a lot of that work has already been done, right? That was, I would say, the first few months of a lot of the tariff implications, right? And so now you're starting to see the OEMs and suppliers move into like, what's my medium and long-term strategy, right? Like, obviously it's not sustainable to continue to pay significant tariff costs. So what do I need to do to start to move my production, move my strategy to respond to these actions? So you've already seen certain, companies make announcements of further investment they're going to put in the U.S. But what we're seeing from our side is that investments, they're still cautious, right? There's still a lot of analysis and, a lot more things that go into deciding to build production facility in the U.S. than just cost, right? So you think about, we have to make sure we have the right labor, right? Certain skilled trades, you see it every day now, right? Skilled trade shortage, whether it's welders or electricians, but think about like, casting as an example, right? That's an area that, there's a very highly skilled labor needed for that. A lot of cost needs to go into that. We're seeing that move pretty slow as companies sort of assess what they build and what they move. But like you mentioned, the supply chain is very integrated across North America, right? So that process of assessing and move it's very complex, very complicated.
Yeah, no doubt. And, speaking of sort of complicated decisions that, companies have made, obviously in recent years, companies, throughout the globe, but even in here in North America, made significant investments into their electrification programs and investing in assembly plants, suppliers investing in their factories, kind of with the thinking that EV sales will take off to a certain point in the coming years. Obviously, those sales numbers, those projections haven't necessarily gotten to that level. And then now, this year, of course, back in September, we saw the federal EV incentive being phased out. What does, we talked about hybrids in Europe. What does, the future of, those types of, investments? I mean, automakers and suppliers have already poured in a lot of capital into those facilities. Maybe they're pivoting now. What might that look like moving forward as, companies try to figure out what their footprints should look like and what their product plans should look like?
Yeah, that's right. I mean, the EV, I would say the slow adoption of EV is a huge impact on the auto industry in North America, right? I mean, like you said, it was the most investment ever made, something like $300 billion. I mean, people were making significant amounts of investment into EVs production capacity in North America in the last, couple years, right? And that ripple down effect and from the OEM to the supplier. And so with that uncertainty of where EV volumes were going to go, it was already sort of disrupting the supply chain, right? We already saw many suppliers, who had invested heavily in EVs, but weren't getting the volumes. Just recently, you've seen more around potential cancellation of EV programs. And so going forward, I anticipate that you're going to start seeing, write-offs of assets, right? Because with that amount of investment and the volume not being there, I could anticipate that into the next year, you'll start seeing, different write-offs. You'll start seeing companies maybe not be able to survive completely on their own. So they would need to, generate, maybe that's a consolidation target. Maybe it's a M&A activity or further cost reductions. And so I think that disruption is going to continue for the next 12 to 18 months.
Yeah, on that note, M&A, that's something that, I've been hearing, especially in the supply side of things, as a potential way to, especially as costs add up and as, companies look to be nimble, to either, look at, spinning off, part of their business. We're seeing some suppliers do that, or mergers, acquisitions, or we're seeing companies even look to pursue partnerships, maybe more than they might have in the past. You said, we can expect to see more of that over the next 12 to 18 months. How might that kind of change how, the supply chains even look in North America? I mean, to have essentially companies partnering or merging that right now are competitors. I mean, what are the ramifications of that long term?
Yeah. Well, that's actually my favorite topic. So I love, M&A. I think it's very neat. It's been needed in the supply chain. It's needed at the OEM level. I mean, the industry has actually gotten much more fragmented over the last 10 years. If you look at the introduction of, EVs and new players at the OEM level, that then ripples down to new suppliers. So the industry has actually gotten much more fragmented. And I do believe that the industry is in need of consolidation in many areas, right? It's just deals in auto are very difficult. You have, direct competitors. Buying out a direct competitor is not an easy transaction. There's a lot of rules to follow. There's a lot of things to follow, but there's also it's just not an easy deal to get done because you're dealing with two competitors. Now, that being said, I mean, I think there will need to be more consolidation, and the buyers will have to get comfortable around fundamentally, auto industry boils down to, platform mix, right? Platform mix, program mix. So are you on the right platforms? Are you on the right programs? Are those programs profitable? And, that's where the sort of rubber hits the road in doing deals in auto, right? Like, you really need to get down to that level of detail. You need to understand what the forecast looks like, what platforms they're on. And that's how it makes sense, right? Because in some cases, if you're a competitor, you look at why would I buy that business if they're on all the wrong platforms, right? And so that's what makes deals really difficult in auto.
Yeah, it's going to be interesting to see how that plays out moving forward. Really over the past several years, I mean, we go back to COVID, through the semiconductor shortage and all the supply chain shocks, inflation. I've been hearing a lot from companies about how they, like to say that they feel like they're more nimble now than maybe they were, before COVID or several years ago. Generally speaking, do you feel like the industry is at that point? Does it have a long way to go to kind of be able to be as nimble as it wants to be? Or I guess, how would you assess kind of where the industry is at when it comes to, I guess, resilience? Given all these shocks to the supply chain in recent years.
Yeah, absolutely. I actually think that's better. That word's better. Resilience versus nimble. I mean, the industry's not known for being nimble. It does take time, but it is resilient. And, when COVID hit, for example, we thought there were going to be a ton of bankruptcies, like 08, 09 kind of level, right? And you saw very few. When, the EV slowdown or the EV, the slow adoption of EVs was happening, we thought there would be much more impact, right? Tariffs as an example, right? When tariffs hit, it was going to destroy the industry. Still plugging along, and people are still generating cash. And so I think they just take the hits. The industry takes the hits and, adapts and moves and is able to find a way to get through it. I mean, the real question is, how long can they withstand the compounding volatility, right? As things happen, right? You see more and more, things, what could be next that's going to take a hit. And I think that sort of playbook that the OEMs and suppliers, has been very well vetted over the years, just continues to adapt. And the question is that going to be enough as you continue to see these volatility?
Yeah, that'll be the question. And, as we monitor it, we'll stay in touch. It's going to be interesting. Lenny LaRocca, U.S. automotive industry leader at KPMG. Thank you for joining Daily Drive.
Yeah, thank you. I really appreciate it.
That's Daily Drive for today. I'm Jake Neer, in for Kellen Walker. Thanks to automotive news journalists Omari Gardner, Hans Greimel, Lawrence Iliff, and Molly Boygan for their reporting for today's podcast. You can get the latest news on supply chains, U.S. manufacturing investments, and everything happening in the auto industry at autonews.com. Come back tomorrow for a conversation with Colin Hendricks, Senior Fellow at the Peterson Institute for International Economics, who talks more about the U.S. dependence on China for rare earth minerals.
The real problem is going to be finding municipalities in the United States that are willing to onboard what is an incredibly energy-intensive, water-intensive, and not particularly lucrative or high-margin kind of process.
We'd love to hear from you. Let us know what you think of the show and the topics we covered today. Send us an email at dailydrive@autonews.com or leave us a voicemail at 313-444-2774. And if you enjoy the podcast, remember to like, leave a review, and subscribe so you never miss an episode.